Good morning, traders. This is Michael coming to you from Game Edge on Thursday, September 25th with our pre-market prep session. As always here at Game Edge, we'll cover our three pillars: sentiment, structure, and trends. So let's go ahead and jump right into it. Currently looking at our market trend model. This is based on the tick index, so quick orientation. The bolded white CT is the intraday instantaneous cumulative tick. This is indicating buying versus selling in the overall market. We discussed about the possible weakening of the tick after this large day up, and then we saw it crossing below the shorter term moving averages, railroad tracks or momentum moving averages. Once we're under these shorter term moving averages and then we actually start seeing these cross to the downside, this is indicating obviously significantly more weakness possible occurring into the overall market. And then we continued in yesterday. Plus 1,000, or sorry, new highs versus new lows breadth indicator, obviously almost at parity yesterday. So this is definitely indicating more stocks are being almost sold than bought, a slight edge to the buying, but fairly flat compared to the previous days, as you can see across the board there. And then our plus 1,000, minus 1,000 block orders, institutions, we've actually had three out of the past 4 days that were to the downside, so institutional selling. And we start seeing these multiple days stacked on top of each other in a weakening overall cumulative tick or market trend model, then we take notice and we're cautionary obviously to the downside. And we're seeing some other tools weakening also that we discussed in our pre-market prep. And then obviously yesterday selling pretty significantly to the downside. So what we'll look for now, we've crossed below the colored ribbon on our tick USC. This is all exchanges here, so this is a little bit more sensitive to the selling. So what we'll need to see is this tick start to recover back to the upside through the colored ribbon. If we continue to stay below the colored ribbon and we start getting negative slopes in the colored ribbon, this obviously could lead to a little bit more pullback in the overall market. So we'll monitor this day over day. Moving on to the tick RC, this is what our mechanical portfolio, our P-Trans to PX portfolio is based on. And when we start seeing negative slopes in the colored ribbon, one of these, which is the red, then our mechanical portfolio turns off. So we would not be entering positions now in the mechanical portfolio. And obviously you saw this weakening yesterday into like the afternoon hour, and then we continued that at the open yesterday. So if you were thinking a bounce in the overall market or long, this should have quickly been dispelled, obviously, with our market trend model. So now what we watch for cutting into the colored ribbon is, do we start emerging outside of the colored ribbon to the downside, indicating a larger pullback in the overall market? Or do we come down and see the start turning back to the upside, crossing the shorter term momentum moving averages, and possibly heading back up again, starting that uptrend to the upside. So we'll see how this plays out day over day. As of now, we could stay as we head into the open today, and obviously you're seeing a pullback here pre-market to 6,600. All right, let's look at the SPX options complex. It's the largest, most notional value. We separate it SPXA and SPXP. SPXA are institutional positioning. For the expiry into October. We're still call dominated, but we notice the net GEX continues to drop as it's not as strong as it was. So we're at a kind of pivot point in the overall structure. This could turn towards put dominated if we continue to see price continue to drop. So we'll continue to watch that. Transition areas are really important. We're below the transition areas now. We've talked about holding above transition in this full uptrend, and now we're seeing us drop below into these transition areas. So slight cautionary, you'll notice to the downside, we do see some out of the money put hedging start to come in. This erodes those in the money calls below us. Out of the money speculation is still maintained, but we'll see if this continues to erode or change day over day. So we'll watch this within the overall transition areas. At the very least, we need to get back above the transition areas for an opportunity to move up towards 6,700. All right, let's look at the SPXP. Obviously, you'll notice if you look day over day, that the left-hand plane, which is below spot price, has degraded pretty significantly. These green net deltas have now changed to red. This is obviously indicating that the out-of-the-money put speculation has increased pretty significantly to the downside, as well as in-the-money calls possibly being closed. Put dominated now on the SPXP full expiry, so this has changed. And we talked about this as a fulcrum point. Net GEX, this is fairly balanced, so we could go either direction. Pull back more to the downside with the out-of-the-money put hedging, or this repairs itself and we do see speculation to the upside at 6,700, which is PGEX, then obviously COI still being maintained up there at 6,750. The key takeaway today is our transition areas from all expiries as well as 0DT are a confluence of 65, 50, 55. So this is unambiguous for the bulls that we need to get above. If we see us have a bounce up towards this level and reject, then we'd be short for the downside and continuing to maintain that weakness. Then we see the out of the money, the JPM short call strike, which is down here at 6,500, 6,505. So the closer we get down to here, the larger influence it continues to have. So we'll continue to watch that day over day. All right, let's move in the Game Edge GEX ratio, or what we call put call ratio, but we add a time component to it. We've been discussing really this divergence, that if you're going to see a divergence with the SPX rising as well as the gamma ratio dropping, that's indicating short dated call speculation is starting to degrade, and then out the money put hedging is starting to come in. So that's our short dated call gamma versus put gamma, and then we see a drop in the overall ratio. So this again repairs itself one of two ways. You see SPX spot price continue to drop, as well as the gamma edge ratio continue to drop, again indicating how the money put speculation is ramping up in the overall structure or complex. Or the SPXP GEX ratio drops, and the SPXP price drops, spot price, and then the GEX ratio starts to balance out and move back to the upside. This would indicating short dated call gamma coming in to the overall complex, speculation starting to turn back to the upside. This one level, again, historically is an area, it's a balance area between the calls and puts. Below that, we're bearish. Above that, we are bullish. And we're at 0.98 right now. So again, you'll notice across the board with our tools, we're at an inflection point where we can continue to drop to the downside, or we might see a bounce back to the upside. So we'll watch this GEX ratio and see how market participants are positioning for either the upside or the downside. And historically, you can see the extremes. When we reach this 2 level, we are at 1.8, or the downside, this 0.5 level. That's when we historically see a bounce to the upside as we reach extremes in the put call ratio or the gamma edge ratio here. Delta bounce for the SPXP. I believe pre-market yesterday, Taylor talked about the weakening of the delta balance. Again, we separate this in the right-hand plane and left-hand plane. So the right-hand plane is the green dotted line. That's the out of the money call speculation. That's usually what we start to see dropping very rapidly if we're going to see a pullback in spot price. And then we see the left-hand plane. That's that out of the money put hedging or in the money calls below us. That will continue to drop. The left-hand plane is still above zero, so we're still maintaining a decent amount of in the money calls below us. The right-hand plane is dropping significantly, so our out-of-the-money call speculation is dropping, exposing those in-the-money puts overhead. Now, we do see a quick bounce today, possibly flattening out to the zero line, but then weakness coming back in towards the end of the month, end of the week 29th, and then we see a recovery towards the end of the month on the 30th, obviously with end of the month flows. So we'll see how this continues to change day over day. Again, quick takeaway is weakness in the right-hand plane. So that's your out-of-the-money call speculation dropping. So price appreciation to the upside will be difficult. And we're starting to see a drop in the overall delta balance as the aggregate of these, as the right-hand plane is overrunning the left-hand plane. So we're seeing the delta balance drop below zero. So again, that's a weakened state and slightly bearish as we head into today. All right, let's look at our net stack command. This is the highest sensitivity levels for today. You see the net delta now is in the money calls below us, in the money puts above us. So we call this locked horns. It can be difficult for price appreciation to the upside as well as the downside as long as we're above these key levels. Obviously, 6,400 is significantly below us at the moment. And you see charm levels, 6,600. If we get below those, that will basically keep a lid on price trying to move back up. And again, that could induce a little bit more downside weakness. Then you see 6,700 above us. And then gamma, obviously 6,600. If we're below that, we could have more fuel to the downside as the out of the money puts here actually become in the money. And this gamma below 6,600. Then you see 6,690, those out of the money calls matching that 6,700 to the upside. And then volatility, obviously we're seeing a spike in volatility this morning, but if we see an overall drop, then 6,600 will be extremely important to get above and stay above, and then 6,700 to the upside. All right, let's move on to the SPX P0 DTE complex for today. Drunken Sailor range to the downside, 6,620. We're well below that this morning, so that would be the first area we'd look for a rejection. At 6,600, we're watching that level for supportive type action. Below that, as I've already discussed on the net stack command, the next level to the downside would be 6,580, and then 6,550. We would not anticipate us to go lower than 6,550. We would anticipate a larger bounce from that level unless the market is really going to do a full reset. And then we'd start looking for 6,500 to the downside, which is the JPM short strike down there. If we get back within the overall Drunken Sailor range, our first target to the upside would be the transition areas. We'd look for some rejection in there And then above transition area, we'd be looking for the top of drunken sailor range, 6690, that's PGEX, COTMC, and then 6600 to the upside if we see a large V-shaped recovery rebound. So down below this, obviously down below drunken sailor range would be short for more weakness down towards 6600, and then ultimately 6580, and we look for some stalling and possible price reaction around there. Put dominated above and below spot price, so again, going to be difficult for price appreciation unless we see a large change in sentiment and structure via our vol M command to the upside. We'd have to see the puts closing positive put centroid as well as a positive call centroid slope for price appreciation to the upside. If we see both slopes to the downside, again, we'd be looking for more downside, and we'd be positioning ourselves for a move down towards 65.80 and 65.50. All right, before we go to the trading view chart for this morning, join us at gameedge.us, click on the newsletters, put your email in here. You'll be delivered on the weekends, our Saturday Beyond the Bell. And then go ahead and look at our free courses, Gamma Edge Fast Pass. This is our flagship options course. Make sure you sign up for that. Again, all free, delivered to your email. And then 2 other courses, School of Options and the Mental Side of Trading free course. And then as always, come join us in our Discord. Click on the pricing tab. Extensive trading community continues to grow daily. We have members of all backgrounds as well as experience levels from new traders all the way to experienced money makers, former market makers, and large account managers also. So again, come join us. We'll help you get up to speed very rapidly and figure out gamma delta and how to navigate the SPX option structure as well as individual equities. All right, let's head on to the trading view chart this morning. Again, we're chopping around the 6600 level. We had our first reaction responsive area here. Again, we're really talking about that. If we're below 6600, we see more weakness down towards 6580, and that'd be that first stop for us to most likely see a bounce. A bounce up towards the top of drunken sailor range. That'd be our first rejection point, and really where we'd be looking to get short for a move back down towards 6600. Again, if the market trend model continues to stay weak, as well as our intraday vol M command. If we do get above drunken sailor range, then we have an opportunity to move up towards transition areas as 0 DTE as well as full expiries up towards the 6650 level. And then we'd obviously have to be watching the intraday volumetrics. We'd have to see positive call slope, out of the money call speculation help us drive back towards that transition area. And then we'd be looking for a possible rejection as we get below the overall transition area. So hopefully that helps for today. Hopefully you've been watching us day over day, talking about possible weakness, following our market trend model. If you're not a member, we streamed this live, and we're talking with members yesterday about the market trend model moving to the downside, being on the correct side of the market. We were looking for more weakness, and then some of our tools obviously were indicating that the SPX option structure was degrading to the downside. The out-of-the-money put speculation was coming in. Out-of-the-money call speculation was starting to wane, so that, again, led to the overall move to the downside. So hopefully that helps. I'll answer Daniel's question. If anybody else has any other questions or would like to go over single stocks, I'd be happy to look at them this morning. So, okay, so Daniel was asking for the morning. Good morning, Despin. When you have a moment, can you describe how to eval price action when it opens below DS range like today? Like, do we just rely on significant levels? So Daniel, key points here are our net stat command as well as transition levels. If we're below transition, we're already in a good morning, Sina. If we're below transition, we're already looking for a weakened state. If we're below drunken sailor range, you're already looking for a weakened state. So we'll go back to the web app that I just discussed, and we'll kind of go through those levels. You see, obviously, all this the significant amount of out of the money are going to be these in the money puts that we've captured overhead, right? These were out of the money, and then as we continue to drop, we capture those. So those are going to be significant weight overhead as the out of the money delta above you continues to grow throughout the day as long as you're below those levels. Dealer market makers have to continue to hedge that above us. And then as we continue to drop, this is without the intraday volumetrics of market participants actually mechanically opening of out of the money puts. Obviously, those are negative delta in our book, positive delta in the market maker book. Market maker has to sell the hedge. So again, causing price to drop, right? So below drunken sailor range, 6,600 is a key level. We're capturing some of these out of the money puts will become in the money. If we're below that level, then we will capture that large amount of negative GEX as well as put OI. Those become in the money, right? So that's that key balance point where we talk about moneyness matters. So these now become significant negative delta in the overall options complex. those deltas continue to grow if you're below that level because they're in the money, right? So there's a limiting towards -1, and dealers and market makers have to continue to hedge that if we're continuing to blow that. And as price continues to drop, you're capturing more and more of these out of the money puts. They become in the money. Again, just continuing to add towards that negative delta, right? So as we increase the negative delta in our book, the dealers, market makers book continues to get longer because they're short those puts. So obviously they have to hedge to the downside, right? So obviously they have to sell to hedge. So that's how we look at this. At each one of these increments that we continue to add negative delta, we'll reach a balance. We'll reach a what we call a extreme point or a greed component, where most likely you'll see some monetization, right? So we'll look at that COTMP level at the open and see where it's at. That's where out of the money puts go in the money. So 20 delta goes to 50 delta, right? So where is that, extreme uncle point for the put holders where they start to see some monetization? And we see that with our intraday volumetrics tools. We'll see usually a large spike in puts. Again, we don't know if those are bought or sold, but that usually will put a level, and then we'll look at the vol-m command where the mass of market participants are transacting. Are they transacting further to the downside, or are they transacting right along that 6,600, right? So if the mass of market participants are not transacting lower out of the money puts, then the likelihood of us going lower for the day starts to drop off a little bit. Now, if we continue to see those out of the money puts spike via our volume analysis at 65.90, 65.80, 65.70, then market participants are again transacting to the downside, mechanically opening those puts. Our book gets more negative, dealer book gets longer. And that's how we use those intraday volumetrics in our tools within our Discord to really understand where market participants are hedging, right? Or not hedging, but transacting, where they're speculating, right? So most market participants speculate with 20 delta. So where's that 20 delta line? Does that continue to drop to the downside? And the speculation continues to ramp up. Market's probably going to follow that. Now, the market rarely goes where speculators are not, right? So again, if we're not seeing that speculation to the downside, 65.70 or 65.90, 80, 85.70, if we're not seeing that speculation, then it's not a high likelihood that we're going to just drop down into those levels, right? So then it's like, okay, well, what are we going to do? Well, most likely we're just going to continue to chop around that 6,600, and then we'll reach a balance point for the day, or charm will continue throughout the day, and charm overhead will continue to grow, and that will continue to incrementally push you down. Now, it won't be like a fast move to the downside, because mechanically opening, delta is king, right? So the mechanically opening of contracts is our delta, but charm will just be that that kind of overhead wet sponge that continues to push on your head, right, to the downside. So you just continue to drop slowly and slowly. And you see that on trend days. Same thing with being above those key levels, right? You'll just see us be kind of buoyant, right? And you'll just continue to incrementally slowly traverse to the upside, right? I mean, just right? So there's just not any urgency from market speculation or market participants, and you just get that grind to the upside or that grind to the downside. So that's what we look for at the open, right? Where are they speculating? How much are they speculating, and how rapidly are they speculating? So that's what we look at. Hopefully that helps. Does that help you understand? And obviously the key levels. So 6,600, 65.80, you see that large gradient, or you see a gradient there. We're actually negative or negative net delta there, right? Significant amount of puts there. And then to the other downside to be 65.50, right? So hopefully that helps. So let me know, Daniel. That was a long explanation, but that's how we look at it. Okay. So moneyness matters. That's why we've trademarked this. Grabbing those out of the money puts that become in the money. You just stack that stuff, as you continue to move down. And that's why we look at the intraday volumetrics, right? What are market participants doing? Are they speculating to the downside, or are they just chopping around the 6,600 level? Yeah, awesome. And then conversely to the upside, right? Do we see the speculation start to go away to the downside? And then do we see speculation start coming into the upside at 66.20, at 66.40? Those would be 20 deltas to the upside, most likely, right? So if we start to see those ramp up, then the high likelihood that we're going to see a bounce back to the upside, right? So it's just that back and forth action of market participants that we want to look at. And then how do those deltas and how do those Greeks Market makers have to hedge, right? I mean, it is a mechanical function of speculation, right? So this zone is based on pre-market net OI data, but after the market opens, because you do not get net OI updates throughout the day, Roger. Nobody does across the board, right? That's CBOE. Now, there may be some people that get net OI updates, but we're talking a significant amount monetarily wise that you would have to pay for that data. But most paid services do not get net OI updates. It only settles from the CBOE at 4:30 or after 4:30, right? So our net OI from our web app doesn't change. Now, as price traverses the SPX option structure, we recalculate the Greeks, right? This is where the moneyness matters. This is where the delta changes. Yeah, exactly. So, and the other thing is, all of this coming into the day is a large number, right? There's 325,000 OI. And yes, we're going to have new OI come in, but it's all 99.9% of it is all 0 DTE. So that's stuff that has to be hedged for today, right? So that's why we look at the volume. Like, where are the mass of market participants transacting? Are they transacting higher or lower? Again, we don't know if they're bought or sold. We can look at flow data. Again, not throwing flow data under the bus, but the tags are assuming lots of things, right? Bought to open, bought to close, sold to open, sold to close. There's lots of assumptions with tags, right? And yes, we can look at the options chain and we can make assumptions also, but we just like to look at volume, right? Where is the massive volume? And we can make assumptions also, whether there's spreads or whether there's something else going on, right? I think everybody's seen the ICs that come in at the open, right? Just massive, right? I mean, so everybody knows things are happening, right? So where do those ICs come in at? Okay, those are key goalposts that might be set for the day, right? And that's why we set the drunken sailor range. That's why we set our transition zones. And we believe we're the only service that does transition zones, right? Of knowing when this matters, right? Where you go above this level, you're in a more call dominated positive gamma state. You're below this level, more negative gamma state. And what does that mean, right? Above, more dampened volatility. Below, increased volatility throughout the day, right? Because of hedging and everything that's going on with negative gamma, right? And we know that market makers hedge in different directions. That's mechanical across the board. They hedge away from certain levels and they hedge into certain moves. Everybody knows that across the board. So that's just, well-known data. But what we want to do is we want to look and understand how the structure is changing throughout the day via market participants intraday. How's the 0 DT structure going to change? And then how are those Greeks affecting market participants and the price action, right? That's what we want to look at. So, and obviously delta's king. So mechanically opening and closing of contracts swamps everything else, right? If I see volume speculating to the downside, nothing else matters. Market makers and dealers don't matter. They're hedging to flat. They're just they're providing liquidity, and their whole goal is to be delta neutral. So they could care less about the spot price or where the lines are at, TA, like anything like that. When a large order comes in that is speculating to the downside for 0 DTE, they have to hedge that. It doesn't matter. It's like, they don't care about anything else. They just have to hedge that. That's it. And that's where the edge comes in mechanically of understanding that. So, all right, thanks everybody. 6 minutes till the open. I got to run over to our Discord and jump in with our members. Again, like and subscribe on X and YouTube. You'll be notified when we go live with intraday content. And then look at our previous pre-market preps and how it's led up to today and how we were looking at market weakness as well as individual equity. So, all right, thanks everybody. See ya. Make it a great day.